What are the loan programs available, and how do you choose what loan program is best for you? Today we're going to be looking at 4 of the traditional loan types. The first one is a conventional loan, and this is the only non-government backed mortgage we're going to talk about today. And what that means is this loan type, the government does not insure the lender if the borrower were to default, and that's going to matter. The minimal down payment for a conventional loan for first-time homebuyers is only 3%. And this is a huge misconception. Many people believe you need 20% for a conventional loan, but I want to clarify only 3% is needed for a first-time homebuyer. Minimum credit score is 620. And because this loan type is not insured by the government, if you put down less than 20%, then you're required to pay private mortgage insurance with your monthly payment. But with a higher credit score, private mortgage insurance is typically lower than you might think it would be. The next 3 loan types we're going to talk about are all 3 government-backed mortgages. And because they are insured by the government, each one has a special ability, or you could say superpower, that's specific to them that a lender wouldn't normally offer, but because they're backed by the government, that they're able to offer these. So FHA is the first one we'll look at, and its special ability is there are more lenient credit requirements, meaning that if you have potentially a lower credit score or maybe some old credit history that is not excellent, then the interest rate and mortgage insurance cost are not as sensitive to your credit score. And so sometimes you may not be qualified for a conventional loan, but it will work as an FHA loan. So more lenient credit requirements. The minimum down payment for anybody, not just a first-time home buyer, is 3.5%. And there is an upfront mortgage insurance premium. And this is a cost that's typically rolled into the loan amount, so you don't really ever see it, even though it is a cost. And there also is a monthly mortgage insurance premium, and those 2 things are what funds this program. The next is the VA loan, and this is available to veterans and active duty service members. And its special ability is it has a 0% down option. It also has no mortgage insurance fee, but there is a funding fee that's also typically rolled into the loan amount, and that is what funds the VA loan program. The last one is the USDA loan, and this was actually created to incentivize people to move to more rural areas and outside of the city. So you can only use this loan program in certain geographical locations. And its special ability, you could say, is there's also a 0% down option. And there is an upfront and ongoing guarantee fee that is what funds this program. So you may be thinking, oh, there's so many programs, so much, this is overwhelming, how do I choose? And so the way a mortgage advisor would work with you and help you choose what loan program is best for you is they're gonna look at 2 things. Number 1, eligibility. What do you qualify for? You may not be a veteran, or a conventional loan may not work for you. And so first we wanna see, what do you qualify for? And so the second part, and this is so important, is suitability. So eligibility versus suitability. And suitability is looking at what loan program is most suitable for you and your financial needs. What is the lowest cost program? And I want to point out, I'm not saying what program has the lowest interest rate, but what has the lowest cost. And so one pro tip that I want you to get from this lesson is a lower interest rate with the wrong mortgage program and strategy can actually cost you more over time than a slightly higher interest rate with the right mortgage strategy. Because interest rate's not the only thing going on here. We're talking about different size down payments requirement, mortgage insurance, upfront fees. And so it's important to work with a true mortgage advisor who's going to help you find what mortgage program is most suitable for you. In this next section, we're going to talk about looking on the inside, how a lender determines how much you qualify for.